You got some unfortunate news for Tesla stock investors as the billionaires quarrel with President Donald Trump on social media sites. The back and forth caused Tesla shares to tank as much as 18% on Thursday before recovering and falling more than 14% as of end of day trading on Thursday. So, I'm going to discuss the details of what was said, the back and forth, what it could mean for Tesla stock investors, and if this is a buying opportunity now that Tesla stock is down 14% and is trading under $300 a share again.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Elon Musk and Donald Trump are going back and forth claiming accusations on each other after Elon Musk was disappointed in the tax policy and spending bill that's circulating through Congress. On Thursday, Elon Musk provided an ultimatum after Donald Trump proposed cutting the billionaire's government contracts following his one-time advisor's repeated exhortations for Republicans to vote against the president's signature tax legislation because of how much it'll cost the U.S. government. The easiest way to save money in our budget, billions and billions of dollars, is to terminate Elon's government subsidies and contracts, Donald Trump wrote on his social media site. So there's a lot to unpack there. First of all, Tesla has benefited significantly from government subsidies, the tax credits for electric vehicles, and all of the other tax credits and fees that Tesla's been able to generate because of the government forcing other car manufacturers to produce electric vehicles or to pay other electric vehicle companies if they fail to meet those guidelines and produce more internal combustion engine vehicles than they're allowed to produce. So Elon Musk has done an excellent job in benefiting from the government subsidies and government rules to propel Tesla forward to where it is today. And in this new tax legislation, the US government is aiming to eliminate that $7,500 tax credit for purchasing electric vehicles. Already, Tesla's automotive sales, were down 20% in the most recently completed quarter. And you've seen me do videos on Tesla with early indications for sales in the second quarter, which Tesla hasn't reported yet, but we've gotten estimates from other sources that signal Tesla's car sales are down again significantly in the second quarter. Tesla's losing huge market share, and electric vehicle sales growth everywhere outside of China is slower than expected. In the United States, electric vehicle sales are growing, but they still consist of less than 1 out of 10 purchases. Electric vehicles, for most people, are more inconvenient and more expensive than traditional internal combustion engine vehicles. And so sales have been struggling to increase. And if that 7,500 tax credit were to be eliminated, that would really cause sales to struggle for electric vehicles. So understandably, the Tesla CEO is not happy with that legislation that aims to cut that $7,500 tax credit. But the CEO says that the reason he's not happy with it is because it increases the deficit and it causes all of these other, all of the points to some other reasons. Of course, he's not interested in his own company, in increasing his own wealth. That would not be the way that he would present that case. Of course, he would say it's for other reasons. But that $7,500 tax credit is a major facilitator of sales. And if that's eliminated, that would be terrible news for the electric vehicle industry, which is already struggling, right? You've got so many companies that are going bankrupt already. Last year it was Fisker. This year you've had a couple that are on the cusp. Nikola, the truck, big truck manufacturer, and this credit is essential. And understandably, the CEO wants to defend that credit, does not want this tax bill legislation passed. So Tesla shares were down 14% on the day, but Tesla shares are still ridiculously expensive. I've got here 4 other companies and Tesla, and I'm measuring on the forward price to earnings ratio. You can see Tesla stock is trading at a forward PE of 162. And even if you could, if you say, okay, Tesla, you are an AI company, even before you've even produced one driverless car, we'll give you that. We'll say that, you know what, you're an AI company. We're tired of arguing with you. We're just going to say you're an AI company. So let's compare you with other AI companies like NVIDIA and Microsoft. Well, NVIDIA and Microsoft are trading at forward price to earnings ratios around 30. So Tesla's trading at a valuation more than 5 times that of NVIDIA and Microsoft. More than 5 times that of NVIDIA and Microsoft. Let that sink in for a moment. Tesla has yet to generate $1 of driverless car revenue, and yet is trading at 5x the valuation of Hall of Fame AI companies, NVIDIA and Microsoft. But it gets even worse. If you compare Tesla with car companies, Ford and GM are way down here trading at forward price to earnings multiples of around 5, because car manufacturers and car companies are not an attractive investment. It takes large capital investment, very competitive. Labor has strong negotiating power. Profits are notoriously thin. It's a cyclical business, very risky, not attractive, right? So you can understand why Tesla continues to market itself as an AI company, because it earns this kind of valuation as a car company, right? More than 80% of its revenue and profit comes from car sales. And that's going to be the case this year. That's going to be the case next year. That's probably going to be the case in 2027. Maybe in 2028, they'll start to generate some driverless car revenue. Maybe. And meanwhile, the other parts of its business are doing well. The energy segment is doing well, and it's growing to become a larger segment for Tesla overall. And I suspect it will continue to grow to become a larger segment for Tesla, because car sales will continue declining. So even if energy sales remain flat, car sales continue declining, the energy segment becomes a bigger part of its business because car sales are declining. So I've been saying I don't think Tesla deserves this kind of a premium valuation. It was too expensive. And so a lot of hope was included in Tesla's share price at those valuations. I calculated a discounted cash flow valuation for Tesla, and the intrinsic value per share I calculated was $81. That's how much I think Tesla shares are worth today. But look at my assumptions before you go saying that I'm not giving Tesla credit for growth in the business, right? So I'm forecasting that Tesla's free cash flow will grow from $5 billion in 2025 all the way up to $93 billion by 2035. So I'm forecasting that Tesla's free cash flow will grow by nearly 20x in the next 10 years. 20x increase in its free cash flow. So I'm forecasting growth in the business as a result of the driverless car technology eventually. I'm forecasting that. I'm giving them 20x growth, and I'm coming up with an intrinsic valuation of $81. So I've seen some estimates for Tesla at $1,000 or $2,000 per share. Now imagine what those estimates include to get Tesla's shares valued at $1,000. 10 times this. So that would mean that the forecasts are suggesting Tesla's free cash flow rises to $900 billion by 2035 or $1 trillion by 2035. Those are the kind of optimistic estimates you would need to get Tesla's valuation to be much higher. Also, the longer term growth rate I'm using for Tesla is 7%. 7%. This is the highest growth rate I'm using out of any of the companies I'm following, because I'm giving the company credit for eventually developing the driverless car technology and eventually developing perhaps the robotics business. I'm giving them a low probability of developing a robotics business anywhere near what they are forecasting, but I'm still giving them a probability that it happens. I'm giving them a non-zero probability that they develop that technology and make sales and earn profits from that technology. So 7%, the highest out of any company I'm following. I usually give 3% is like the standard long-term growth rate I apply, 5% for some companies that I expect to have a more durable growth path, and 7% for Tesla. And still, even after those optimistic forecasts, the intrinsic value per share is $81. So you can imagine how much enthusiasm is already baked into Tesla's price. That's what I've been arguing for the whole of 2025 here, suggesting that Tesla stock was overvalued. In fact, I started off the year saying that Tesla stock was overvalued and it was a sell. And then when it crashed down 45% to begin the year, I upgraded the stock from a sell to a hold because the valuation had crashed already by so much. So, needless to say, I don't think this is a buying opportunity for Tesla shareholders or investors interested in Tesla. I still think it's overvalued even after this 14% decline. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.